Hi, I'm Barry Clark. Welcome to the Mortgage and Property Podcast, brought to you by Mortgage Monster. Now sit back, relax and get ready for top tips, tricks and advice to help you with all of your mortgage and property needs. Hello and welcome to the Mortgage and Property Podcast. Hope you're doing okay. Today we're going to be talking about all things protection. So I'm joined by my special guest, George. George is a protection consultant who works for a very large insurer and covers around about 1,500 or so brokers that are all looking to give their clients protection, such as life insurance, critical illness, income protection, and really just want to have a bit of a chat with him today just to talk about all things protection, really. So, George, how you doing, buddy? All right?
Not too bad. Thank you very much. Thanks for having me on.
Good. Absolutely brilliant. No problem at all. Pleasure to have you. We've got a few questions for you, first of all, so we like to get to know our guests a little bit more. So, first of all, who's your favourite Arsenal footballer?
Arsenal footballer? None of them, to be honest with you. I don't want to be judged for this, but I'm a big Spurs fan, so I think Barry knows what he's doing right now.
Same here, my family's all Spurs all the way through,
yeah.
So just see how we react to that. To your coffee, bud?
Oh, 100% coffee. 100%.
Yeah. If you could have a superpower, what would it be?
In my line of work, probably be able to read people's minds. Because I think everything would be a lot smoother and a lot quicker.
Okay, that's pretty good. And what would your dream job be?
Dream job? I think it'd be great to be a financial advisor, to cover the whole spectrum of the financial industry. And hopefully one day I'll be there.
I know you're going to start kind of, maybe looking to train at some point soon.
100%. It's all part of the plan.
Yeah, good, mate. Excellent. Cool. All right. So, George, just tell us a bit about what it is that you do. Maybe I've stolen a bit of your thunder already, but tell us about what it is you do and the way you do it. Yeah.
So I'm a protection consultant for a large insurance firm. I manage about 1,400 accounts that can range from wealth and pension advisors to mortgage brokers like yourself. And I essentially help advisors when it comes to protection. It can be a bit of a mystery. Some things can be quite confusing. And I'm there to make sure that everything's as straightforward as possible. Okay. All right, brilliant.
So basically you kind of give lots of training, lots of help, lots of assistance.
Absolutely. So we explain, how the policies work, why they can be beneficial to the client. And of course, getting these policies put on risk, which is the term we use for a live policy when it comes to protection, and making sure that the client on the other end has got the best policy for themselves.
Okay, that's cool. I'm going to go into probably some questions that aren't on here just to see. The main issue that I have with, not the main issue I have with selling protection is that loads of brokers do it. So basically they just sell life, they just sell kick, even when it's not needed. And you'd get all these door-to-door salesmen going back kind of like to Prue times where they were knocking on doors and, they were just selling the wrong type of insurance, the wrong type of people. So I just want to kind of go through a bit of those kind of questions really and talk about what's been happening in insurance previously, where it is now, where it's more heavily regulated now than it was before. I mean, we're seeing advisors, we're seeing clients come to us with kind of all sorts of policies. You look at them and you go,
100%.
What's that all about? They
100%.
Shouldn't be having that.
And it's interesting you say that at the moment, and I'm sure you're aware the FCA are working on their consumer duty at the moment, which is all about brokers doing the right thing for the client. And I think you're 100% correct. Previously and in the past, insurance has been a bit of a minefield for the public. So it all falls down to the broker and the advisor to make sure that the right policy, the right product is being sold to the client. And of course, in any avenue of work, people can become complacent, and that's when the wrong types of policies are sold to clients because, like I said, they don't understand what they're looking at. They just want to trust their broker, they want to trust their advisor that they're getting the best policy for themselves. Now, recently, in recent years, it has got better. And like I mentioned, the consumer duty is definitely helping with that. We are heavily regulated by the FCA. And I think now that the big internet's out there, the general public can do a little bit of research for themselves. They can go out and even if they don't want to take out a policy online, they want to use their broker still. They have those resources to make sure that they are looking at the correct policy, which has definitely made it harder for those let's call them cowboy brokers that tend to churn business or write a policy for the sake of their compliance. And now we're definitely seeing more of a focus on the actual client and what they need.
So is there any kind of minimum amount of insurance that you have to have in order to kind of, buy a property with a mortgage at all? Or
from a life insurance perspective, no. There is no minimum insurance that you have to have. It should be a perspective that you're having when you're taking out a mortgage. It should be, should I have life insurance and should I have protection? And that falls down to the advisor to make sure that they are explaining to the client why they should have it and what it's used for.
And that's exactly brilliant. I say that's a good thing about having you on being a professional, because I say we do sometimes see some clients, they come in to see us and we sit down with them, we start talking about insurance and we're like, when I took out my mortgage initially, they told me I had to have life insurance. If I didn't, I wasn't allowed to have the mortgage. That for me is a massive no-no. It's, a client shouldn't be forced into have some sort of protection because they feel they should have it. There's no kind of legal requirement apart from builders insurance in order to protect the building. But really, I know that we both believe this, but it should be, that we should explain everything to a client, then they make their own informed decisions. I honestly personally think that people are crazy that don't have any form of protection. It's just, why would you kind of leave it to kind of chance? And the other thing as well, our offices, I'm looking at our marketing guys, and our office is quite an ill office. Pretty much most of our guys are all broken at the best time. So they all believe very much in kind of life insurance. It didn't mean it to be that way. It just kind of worked out that way. So basically, as I say, we do see clients that do come to us have been told you have to have this, you have to have that. You don't have to have life insurance if you don't have to have income protection. I think you're crazy not to. As we'll come to that in just a second. So just tell us about the different types of insurances. So talk us through what's kind of available basically.
So when you're taking out your mortgage, the first thing that's going to come up is life insurance, and that is used to cover the cost of your mortgage. Okay. So if the worst is to happen, the money's going to pay out to, say, your partner or your next relative that's going to be in charge of looking after your property to make sure that the mortgage isn't going to be left for somebody else. Now, that is what we would talk about first of all.
Okay.
That's pretty standard. And like I said, usually the cost of a pizza on a weekend. Yeah. Now, when you look into protection in relation to a mortgage, it all comes down to the circumstances of the client and what they need. So, for example, there is plenty of critical illness cover options out there, but it's important to understand what critical illness is used for. Yeah. So critical illness is obviously very different to a life insurance policy because that only pays out on terminal illness or death. Now, critical illness, as I'm sure everybody knows, 1 in 2 of us is going to be diagnosed with cancer in our lifetimes. Now, critical illness is there to make sure that if you have to take time off work and you still need to pay your mortgage, or you need to take a year out to have something like chemotherapy, critical illness is going to provide funds so that you can support yourself and your family while you're outside of work. Now, that closely ties in with income protection as well. Okay. Now, income protection is different because that is a monthly payout based on your salary.
But whereas the other two periods, they're like a lump sum payout. They're a one-off lump sum payout. So if, say, for example, you were to pass away, it pays out a big chunk of money, which is normally,
that's correct,
you'd have that amount to kind of cover your mortgage. So if it was kind of an interest-only mortgage, you'd have probably a level term.
Absolutely.
If it was a mortgage goes on over time, so your repayment mortgage, you'd probably have a decrease in term.
Absolutely, yeah.
So that means in the event of death, and it pays out a big lump sum, and that's essentially been paid off.
Exactly.
It's the same with critical illness as well. So a big lump sum of money. And that can depend on what you took out for in the first place, and it covers you normally against, I know with your insurance company, it's 50 definitions? How many definitions?
Yeah, so at the moment, a lot of providers are coming away from this conditions race that we call it. And we're now sort of taking a more impact-based approach. So a lot of providers will do the same thing. For example, if you're diagnosed with a condition that is similar to motor neuron disease, but it's not motor neuron disease and it has the same impact on you, then these providers will pay out that lump sum for you.
That's brilliant.
Now, critical illness, like I said, it is paid out in that lump sum. And it is going to be more expensive because it's paid out while you're still alive, and you have the option to use that money for whatever you so choose to use it for, whether that be to pay off the mortgage while you're still alive to make sure that if anything worse was to happen, the mortgage is done, or you can use it to provide financial stability for your family while you're ill as well. Now, critical illness is something that over the last, it's hard to put a time scale on it, but it's got more popular because people are more aware that they're going to be diagnosed with cancer, heart attack, stroke. They're the three most commonly claimed illnesses on critical illness. It is more expensive than life insurance, but for that good reason, that it's going to be paid out while you're still alive, so you can provide the financial support for your family.
Well, I mean, the reason it's more expensive is because you're more likely to use it.
Yeah, 100%.
Which is the reason why it's more expensive.
Yeah.
In the fact that, you might kind of, a certain amount of people would pass away during the time they have the policy, but more people would get ill in it because, like you say, there's the kind of the big three, the big four, some insurers call them, which will be heart attack, cancer, stroke, and multiple sclerosis, basically, which are kind of, the big ones which most of them pay out for. So cover you for those kind of main conditions, but you're more likely to get those than 100%. You are to pass away, which is the reason why it's more expensive. So that tells you in itself 100%, that it pays out quite a lot. You're
paying for what you're potentially going to receive. And critical illness doesn't need to be, it's not necessarily going to be a payout for a life-changing illness that is going to end your life in 5 years.
You may live beyond that and then kind of be okay again.
Absolutely. For example, if you look at the most comprehensive plans out there are providers that will pay out for a diagnosis for type 1 diabetes. Now, as we all know, you can live a completely normal life with type 1 diabetes with some adjustments, but some critical illness policies will pay out a lump sum up to, say, £35,000, so that if you wanted or needed to take the time off work while you're adjusting to your new lifestyle, you'll have that financial stability. Now, that is similar to income protection, but income protection pays out on a monthly basis, subject to your income. Now, income protection is obviously very, very different because you do not need to be critically ill to claim on your income protection. It's designed to support you for 2, 3, 4, 5, 6 months while you're off work. But the plan and the idea is that you go back to work. So it gives you the stability that if you were going to be ill, you don't need to worry about finding money or even claiming on your critical illness, because once you've claimed on that critical illness, 9 times out of 10 it's gone. You can't claim on it again. So income protection, again, is, if we was to talk about the cost of income protection, how likely are you going to use income protection? I mean, I was listening to a presentation by I forgot the name of the firm now, but they were saying that the average person claims on the income protection at the age of 37 years old. This is it's real. This happens to a lot of people, and like you said at the start of the podcast, people like to look back and think, oh, in hindsight, it would have been great to get covered, and I wish I did. Now, I think due to the education that the internet provides, the heavy regulation through the FCA that brokers need to provide to clients as well now, income protection is becoming a lot more popular because they understand the need for it, and that's what's most important.
Income protection is probably one of our favourite products here, simply because it can completely replace your income. So we have been involved in mortgage now and insurance for quite a little while. We start to see now the difference that this makes to people. So, you seem to find the value in insurance when you start to see clients come back to you and they sit down in front of you and go, I've got this really terrible thing, what happens now? What did I take out? Can you please help me? And income protection is absolutely fantastic. So recently now we've had 2 cases, literally in the last probably 6 months or so. One of which was a young lady. She was only kind of mid-30s. She took out an income protection policy, and she ended up with fibromyalgia. Now she went to, which is a disease, so she's very, very tired all the time. Absolutely. There isn't kind of any way of it kind of getting better. So she went to her doctor. Doctor kind of signed her off. She made an application, and she now has an amount paid out to every single month, and that enables her to pay her mortgage, pays all of her bills, pay everything else. Which means that now she doesn't have the stress and pressure of kind of returning back to work again. The other thing with that as well is the fact that, yes, it will get reviewed every kind of few years, but that's a condition that really isn't going to get a huge amount better. She's going to get better with time. So she's now got that in place now to the age of 65. I mean, obviously, she's keen to get back to work again when she's kind of feeling a bit better, and when she can manage the condition a bit more. So obviously then she'll have the option then to kind of, step away from income protection and go back more to work. And if she goes back to work part-time, and also support her as well. But it means now that she has this fixed income and this security of knowing that she can really learn to be able to live with her condition and know that she can still afford to live every month. And that for me is, income protection is fantastic because, as much as we kind of love critical illness, you do have to fall into one of so many boxes. And the only sort of thing you have with critical illness, you can potentially sometimes you can fall between the boxes, which 100%. Means that, you have this fantastic, critical illness policy, and you have a life policy, but sometimes you might find the condition you get isn't one of the conditions, or you don't quite meet the, you don't quite meet maybe the minimum kind of condition amount. the minimum, I can't think of the word.
Requirements for a payout.
Minimum requirements for a payout, for example. Whereas income protection, you can have the same problem, same issue. And even say, for example, you went to the doctor and you were to get signed off for kind of, 2, 3, 4 years while you've got yourself better, or if you, heaven forbid, if you're in a car accident, for example, and you had to learn to kind of walk again, that sort of stuff wouldn't necessarily be covered under critical illness because you don't fall into one of those boxes of total and permanent disability, which we'll come on to just a little bit.
Yeah.
A total and permanent disability. So it means that you won't necessarily get the help you need there and then from critical illness, but income protection could kind of very much cover that void until you're fit and well enough to return back to work, and so you don't need that policy anymore.
100% income protection slides in to cover those grey areas that critical illness and life insurance seems to miss out for a lot of people, and that's why it's becoming more popular. And in relation to a mortgage, you'll know more than many people that a lot of people that take out a mortgage, they took it out with their partner. And based off of that, a very strong mortgage broker that I work quite closely with said that it takes 2 incomes to get a mortgage and 2 incomes to keep a mortgage. Yeah. So income protection can be almost essential if you've got a mortgage with your partner and you get ill and you need to take that time off work. If you do not have your income, that is going to put a lot of pressure on your partner as well. So income protection's there, not so much for a worst case scenario. It's there for, like I said, the grey areas, and it's there for a shorter period of time. That's the idea. And a lot of income protection policies out there on the market, they are designed to help get people back to work. For example, some of the providers will offer recuperation benefits. So they will offer a certain amount of money to allow you, on top of your income protection benefit being paid out, say a £300 recuperation benefit so that you can go and have physiotherapy, or you can get a walking stick if you need a walking stick. Silly things, it really doesn't matter, but anything that's going to help you get back to work. For example, we've had diabetics in the past that have used that recuperation benefit to buy a rice cooker so that they can manage their diet, and that helps them get back to work quicker because they're on top of things. And that's the biggest part about income protection. It's a means to an end. It isn't it's not it doesn't fill a hole like life insurance does, where you're going to have that gut feeling of, oh, my partner's just passed away, the life insurance is paid out. It gives you a different relief that you're still here and you can still live a normal life because you can still pay your mortgage, you can still pay your bills while you're recovering. And of course that helps with whatever you're recovering from, because it takes the stress away from not being able to go to work, which of course in many cases for your client that has fibromyalgia, is only going to make her condition worse. So it's there to support them mentally as well.
So we've had a very similar, well, not very similar, slightly different guy, whereby we've had a young chap as well. He's only in his probably late 20s or something like that. He works at a very big packaging delivery, I don't know,
company.
He works at Amazon basically. I don't know, trying to go around it. Not really there you go. Basically works at Amazon, and his job every day is to work on engineering type stuff, and to basically carry big bits of material from one place to another to make sure it all get pressed out, and whatever else works in a very heavy engineering type role. And every now and again he would have to use quite a lot of his upper body in order to kind of move stuff around. It's quite a heavy, just not that. It's quite a heavy kind of job. And he's just had a problem with some of his back, some of his discs are basically disintegrating. So he put in a claim. He's now been, as I say, signed off for work for a little while, and he's now getting the help that he needs. He's able to take time to basically to hopefully put himself, into a position where he's able to recover better now. And that for him, he's not even in his 30s yet.
Exactly.
So have something like that in place, and that's something which he might have to use for a little bit, and then maybe stop for a bit, and then use again when it gets worse, and then kind of stop for a bit. And there's, most of these policies will mean that you don't have to wait again for the deferred period. The deferred period, by the way, is the amount of time you have to wait for the claim. So it will depend on the premium that you get. So with income protection, for example, you can get your benefits to start from kind of day one. Or potentially you can set those to start maybe 6 months or 12 months in the future. A lot of it will depend on your work sick pay. So if, say, for example, you get 6 months sick pay from your work, you might not want your income protection policy to start until 6 months time when you really, really need it. But the nice thing about most critical illness policies is the fact that even if you have, say, for example, 1 or 2 years off, you go back to work again, you then come off then for the same conditions again, then 6 months later, you don't have to wait again for that period, do you? So you kind of pay you out more or less straight away. Continuation, of course.
Income protection for people like the the gent you were just mentioning there, it's important to understand that when you apply for income protection, you put down what job you do, and your premium will be based off of your job. So, for example, the client you're talking about, because he works a heavy labouring job, the premium is going to be a little bit higher than, say, if you're working behind a desk in an office. However, he, more than anyone at the moment, will understand that it was worth paying that increased premium because he's got that support there. And mentioning the deferred period as well, absolutely correct. And many providers, most providers that offer income protection out there will offer you a wide range of deferred periods, and you can choose, like you said, from somewhere from 8 weeks to 52 weeks being a full year. So it is really designed to fit the needs of the client, and again, that I think is a reason why it's becoming a lot more popular, because you don't have to fit into a box. The box essentially fits around you for income protection, whereas like you mentioned previously, but like you mentioned with critical illness and life insurance, you have to fit in those boxes. You have to tick the boxes, and you have to meet the requirements. With income protection, we take in, especially the larger providers will take into consideration your circumstances and build the policy around you to make sure that it pays out when you need it, but it's also there to make sure you can get back to work when you need to as well.
Okay. So with income protection, is there any are there any kind of jobs that aren't covered by income protection? Because I know, some jobs can be a bit kind of more dangerous than others. I suppose that if you're working up at heights of kind of 80 odd meters and you're a welder on kind of a big thing, you're probably much less likely to die than what you were from someone like us who might get a paper cut, for example. Or
100%. And most providers will put them into categories, so category 1, 2, 3 and 4. And let's say, for example, 4, if you're in category 4, you're not going to get income protection. And it is purely because the likelihood of you having to take time off work in the future is too high. And it's like say, for example, if we put it into perspective, having car insurance. If you've crashed your car, or you're likely to crash your car because you're driving on the most dangerous motorway in the world every single day, your car insurance is going to be really expensive, or you might not be able to get it. And it's the same for income protection. If a provider thinks that they are extremely likely to pay out on a regular occasion, then are they going to cover you? Probably not, because at the end of the day, the insurance business is a business. So the providers need to make some sort of profit, and they need to make sure that they're not providing insurance for people that they consider risky. So like you mentioned, if you have to climb a 50-foot pole and weld a light bulb onto the top of it twice a year, chances are you're not going to get income protection, because although it's only twice a year, the chances of you falling off that pole are quite high. To a certain extent, it's still a broad market, income protection. For example, if you're a stay-at-home mum, you can have income protection. You don't need to have an income to have income protection.
So are there any kind of jobs, for example, that wouldn't be able to get income protection? Talk me through what.
Yeah, absolutely. So each provider is going to do it a little bit differently, but most commonly they're going to put it into categories 1, 2, 3 and 4. And let's say, for example, 1 is you working behind a desk in an office. The likelihood of you getting injured or needing to take time off work because of an accident is very unlikely. To the other end of the spectrum, being category 4, let's call it, that might be somebody that works on the motorway, for example, and is
like putting out cones and stuff, or doing repairs.
So working in a dangerous environment, the chances of you getting income protection there are unlikely. At the end of the day, the insurance provider, they calculate the risk of a payout when you take out a policy, and that's why we call it on risk when a policy is live. And if the insurance provider doesn't think it's worthwhile, then of course they're not going to offer that insurance. To put it in perspective, like I mentioned, is if you're driving on the most dangerous motorway in the world, you need to let your insurance provider know, that your car insurance provider, and the chances are it's going to be expensive because of how dangerous it might be and how likely the provider is to need to pay out in the future. Now, it doesn't mean if you've got a dangerous job you can't have income protection. It might mean that the premiums are just going to be higher. But again, it comes back to you get out of it what you pay for. If the premiums are higher, it's because of the fact that
you're more likely to claim.
You're more likely to claim. The risk is higher. The way you want to look at it, if you're going to take out income protection, is yes, it might say for example £50 a month, but let's say in 6 months' time you need to claim on that £50 a month has just made you
valuable
£2,000 a month to make sure that you can keep paying your bills. But of course, it is broken up into different categories based off of risk for income protection.
I understand as well, you touched on it earlier as well, that you don't necessarily, so there is value as well. For example, I think it was one of the insurers, LNG did a study this recently, which said the value of a stay-at-home parent is normally, as a minimum, around about £20,000 or so. So income protection is designed to protect your income, but it also cover you as well, and provide, even if you were, say, for example, I don't know, say a stay-at-home parent, for example, and that can pay out. I don't know how is it kind of up to £20,000?
I think you're bang on there, up to £20,000. It's going to be different, a little bit different with providers. They'll vary, but it's around that area. And most of the providers I sort of am aware of, it is £20,000, and that is because a stay-at-home parent is just as important as a parent who goes to work to provide the income for the household.
The working conditions are a bit tougher.
Yeah, absolutely, and you can't take a break either when you're working at home. But that's something we'd call own occupation. So, it's just as important as having a full-time employed job or a self-employed job. Because if you get ill and you can no longer look after your children, you might need to pay childcare. And I think that's really important. And it's great that insurance providers recognise that, because there are a lot of parents that, say, for example, one of the parents got ill and the other parent had to take time off work to look after the children. That income protection is going to provide support for both of those parents so the children can still be looked after. I think that's something that not a lot of people know about either. Not a lot of clients that you'll speak to will know that if they're unemployed, they can have income protection. And it's really important to educate the clients on that, because it's a very, very useful policy. And again, the risk of you needing to use income protection when you're a stay-at-home parent is lower. So the premiums are going to be lower than, say, if you're going out and working every day.
Fantastic. Oh, excellent. One of the questions that we were kind of asked, we put a poll out beforehand on our podcast group and said, what questions have you got for insurance specialists? One that's come back and said, insurance companies, they don't pay out. They try and find a way not to kind of pay out and that sort of stuff. Just give us an example of, basically, like all of the insurance companies are now very heavily regulated. So they have kind of, bits they have to pay out for. If you're not happy with that, you can always go to the Ombudsman. You can go to the FCA and that sort of stuff. So, but just, tell me, why would some policies kind of not pay out? In what conditions would it not pay out, basically?
Absolutely. So when you take out a policy, there's something we call duty of disclosure. So you need to be honest about your health conditions. You need to be honest about your work conditions, because if you have been dishonest when it comes to time of claim, whenever that might be, the insurance provider is going to look at that. Now, if you've been dishonest, then the premium you got and the underwriting that's been processed for that application and policy is incorrect. So that invalidates the policy. So that is the main reason that life insurance policies won't be paid out.
So there's nothing assumed above that. Do tell the truth when you're doing and make sure you disclose everything you possibly can.
Absolutely.
If there is ever an issue, you're fully covered no matter what happens.
100%. And there are policies out there that if you have a condition that you find is making you uninsurable with these providers, there are providers that will offer you policies that exclude that single condition. So, for example, if you've got diabetes and the premium's too high for you to take out a fully comprehensive package, you can go to a different provider and take out a policy that covers everything but diabetes. So when you pass away, if it's a life insurance policy, they'll look at the reason for death, and if it was diabetes, then it doesn't pay out. But you didn't pay for that cover. You paid for everything else.
Everything else but that, basically.
But that, yeah. So there are plenty of options out there for you, but it is so important to be honest, because the worst thing for your family, because it's not you that's going to be receiving that life insurance payout, it's your family. And the worst thing for them is when you're not here anymore, you have left this life insurance policy, which for a lot of families is a legacy for the person that passed away. They come to claim and they find out they're not going to get a payout. And I can see why it's really easy.
Hard.
Yeah,
that's
exactly.
really hard.
And it's not just that it's a disappointing feeling for the family. It's also the cost of dying.
How are they going to do it then? How are they going to kind of? You thought you had a way. Okay, brilliant. Well, I can now stay in my home.
Exactly.
Brilliant. We can now continue to raise the kids where they've got disrupted. All of a sudden, it gets thrown into disarray because you lied about lifestyle or whatever else. That's the thing on lifestyle as well. We do have some clients that maybe have led maybe a bit of a party lifestyle and that sort of stuff. We'd always recommend you be totally open, totally 100%. Honest. I'd rather you be covered if you smoke, for example, than if you didn't smoke. And and then later on find out that you are smoking. The difference in premium might have been £10 or £20, but that compared to your £200 life policy paying out really is kind of pittance.
Yeah, and I mean for a lot of people, they think, I'm a smoker, but I'll put down that I didn't smoke or I don't smoke because I plan on quitting in a couple of months. There are policies out there for you to have while you're a smoker that's going to lower your premium.
And then you can change it as well.
And
so
then
you can go
you
back to underwriting and you can go, look,
exactly.
stop smoking now. These are steps I've taken.
Absolutely.
I've shown that I can.
Yeah, and it's important to be honest because, like I was saying, the cost of dying nowadays is about £10,000 just for a funeral. Yeah. And the last thing you want is to get to that point, you've passed away and your family think that they've got £200,000 coming in to cover the funeral, the mortgage, childcare, and it doesn't come in. So now not only are they left to pay the mortgage on their own, but they've got a £10,000 debt because you've got a funeral to pay for as well. And on top of that, all of those premiums that you paid each month, they've gone now. They're void. They disappear, and you get nothing out of that. So duty of disclosure is huge, and like you said, we're heavily regulated by the FCA, and it's something that we and all insurance providers out there are really hot on. We make sure to let the clients know that they must be honest when we're going through an application. 100%.
So let's kind of go back then to kind of say, for example, like a life and kick policy, for example. Mm-hmm. Let's say, for example, we've been through the underwriting. What are kind of the underwriting basically is whereby, but most of the forms, so we'll say to you, we'll explain all the differences to you. These are all the different types of insurances. These are what you can have. These are the costs of those. What do you like to have? Then we'll go through underwriting. Yeah. Underwriting basically means then that we ask, it's quite a few medical questions, maybe like 50, 60 questions. Yeah. In a format. If there's yes to those questions, we need kind of a bit more information on maybe family history, maybe any problems you've had in the past. Maybe you've got high blood pressure. What's happening with that, and how's that kind of managed? Insurers, if you're waiting, say for example, for results for tests, for example, they want to know what it's are first of all before they cover 100%. You. But after we've been through the insurance question, it then goes normally into underwriting. Yeah. So what generally the underwriting outcomes from that? So we'll fill in the form. It will go, sometimes automatically accepted. Other times it will go to be looked at manually. Yeah. So what can happen? What are the kind of outcomes of those?
Yes, good question. So underwriting is obviously really important for life insurance, critical illness especially, because we're going to be looking at what conditions you've currently got, how you're managing those conditions, and based on that information, we're going to either approve you with no loading, so that would be standard terms, which means you'll get the price based off of your age and your gender. In some cases, some providers don't sort of rate on gender, but if you have, say for example, like you said, high blood pressure, it isn't going to be a set. You're getting a 50% loading because of your high blood pressure.
And a loading basically means you just
is an increase in premium,
which is absolutely fantastic. We just need to pay a little bit more for that extra risk.
Absolutely. So, for example, Barry, you've got high blood pressure, but you're looking after yourself. you're going to the doctors. You go to the doctors every 6 months. You get your checkup. You're looked after. You're taking your medication. You're doing as you're told by your doctor, and it's under control. But you have to let us know that you've got it. There is going to be a load-in because you've got high blood pressure, and of course, if you've got high blood pressure, you're more susceptible to heart attacks, strokes, things like that. So there is going to be a slight loading, but each provider will do it differently. But every underwriting team from within the top providers of insurance are going to look at things in detail. They're not going to see you high blood pressure, 50% loading, you've got to pay an extra £12 for your policy. It will be done based off of the client, and that's why it can take sometimes 2 weeks to get through underwriting, depending on the severity of the case and how complicated it is. And like you said, there are some policies out there that don't have any human underwriting. They'll be done by a computer. And say, for example, there are killer questions. So if you say yes to any of those questions, it's a decline. If you say yes to some questions, it's an automatic loading. A great example is smoking. That is straight away a 50% loading on most policies. Yeah,
and that's the thing about using a broker, for example, like we do with mortgages, with insurance brokers as well. All for certain conditions, different insurance companies have different loadings. So, for example, for ourselves, we can kind of ring around beforehand. Most insurers, such as yourself, will have a pre-underwriting line where you go, right, I've got a client with this condition. What is the potential extra additional cost of loading going to be, basically? And what we'll do, we'll ring all the insurers and find out who was what, and we'll kind of then look at who's going to be cheapest and who's going to offer then the best for that. So I think it's a really kind of valid point about actually going to brokers. They'll be able to understand and be able to get the best premiums for you depending on which insurer they go to and find out all that information.
100%, and you can do as much research as you want as a member of the public looking into life insurance, but when it comes to complicated cases like that where there's going to be a load in for certain conditions, going to a broker is the best thing you can do. They have a duty to do the right thing by you and find you the best policy, but they have relationships with the providers. They are going to get an honest answer when they get through to that pre-sales underwriting line, because it's in the interest of the provider to do so as well. It's not to say that you can't do that yourself as a member of the public to go out and try and find life insurance and find the best policy for you if you've got a certain condition. Let's say, for example, diabetes. Royal London are fantastic with that in comparison to other providers. But a broker is going to have that knowledge, and they are going to find you the most suitable policy in the most efficient time as well.
And I'd say things, I don't know, for ourselves, we don't make a charge for any kind of, insurance policies that we sell. We do get a little bit of money back from the insurance company,
of course.
But they're all about the same anyway. We just want to make sure really the client's got exactly the right cover for who it is they're with. So as I say, there's no kind of charge. So kind of why wouldn't you use a broker?
Exactly. There's no charge to you. It's of course the broker's going to get commission. They're not going to do this for free, but it's no charge to the client. And at the end of the day, every broker, the mindset on mortgages and protection should be the same. That I want to make sure that the policy I set up now is suitable for as long as possible. I don't want to be reviewing my client's life insurance policy in 2 years' time and having to rewrite another policy. So that's only going to make their life harder, and it does affect their commission as well. So when you go to a broker, you should feel like you're in safe hands, especially within protection.
And would a client say, for example, would they pay any more for their insurance premium going for a broker than what they would, direct to an insurance company, or is it the same?
It should be exactly the same.
Okay.
Pricing should be the exact same. And like I said, because there's no charge from the broker, you're going to get the same price as if you went on Go Compare.
You might as well get it for free and
exactly.
you might
get
get the advice that you want.
The advice is essentially free. The commission comes directly from the provider, and that is because they've used the provider. It's got nothing to do with the client at all. So, it's to put it into a car perspective again. You can go out and look at cars on your own. You can get up the apps on your phone, or you can go to a dealership and they're going to tell you exactly what you need, what you're looking at, and you're going to feel like you're in safe hands. And it's not so much about the start of the policy, but it's about what the policy can offer you down the line as well.
When you come to point of claim, really is the most important thing, isn't it? That makes sure it stands up.
Exactly, and brokers are going to have that information. This is what they do for a living.
Mm-hmm. So to go back to the underwriting outcomes again, so I know that we had a straight pass, we had a straight decline, we had a load-in.
Yeah.
What else might happen when you go for underwriting?
They can apply exclusions to your policy. So, for example, if we have a client that has attempted suicide, which is a really touchy subject, but mental health has been, it's at the top of everyone's minds at the moment following COVID.
I just want to put the point there. It wasn't until I started doing this job that I only realised that how mental health has affected so many people. 100%. And it wasn't kind of, you look at people from the outside, clients come in and they're all having bubbling this sort of stuff, and then we get to kind of underwriting, you're like, whoa, I didn't expect that. It's just, and it was so much more commonplace than I ever knew before I started doing, before
100%.
Insurances. I really was kind of quite taken aback how common it is, but no one talks about it.
No one talks about it, and of course, no one talks about it because society has a stigma around it.
Scary subject, isn't it?
Of course, and to a certain extent, until recently, life insurance providers had a stigma around it, and you'd get a load-in sometimes for having mental health problems, and you might still get a load-in for those mental health problems, but a lot of providers now have changed their view of it. They've changed their perspective, whereas if you had counselling in the last 5 years, going 2 years back, you get a load-in for having the counselling. A lot of providers now, if you're having counselling, it reduces the load-in because you're doing something to better yourself. But say, for example, a client has attempted suicide or thought about suicide 3 or 4 times in the last 10 years, or they thought about it, in the last 2 years quite a lot. The insurance provider might be willing to offer you life insurance with one exclusion being no suicide. Now, every policy out there is going to essentially exclude suicide within the first 12 months, usually, because that is to avoid people taking out life insurance, committing suicide, and their family receiving a payout. But yeah, it can be, you can exclude many conditions. So don't approach life insurance with the idea that I can't get this because of my condition, because once it goes to underwriting, they might see that you're healthy apart from your fibromyalgia, or they might see that you're healthy apart from the fact that you have a rare condition, and you can have protection for absolutely everything else.
It's about finding really the right provider for that condition. Same as with mortgages, about finding the right provider for that particular issue that you have.
100%.
And the thing we find now, just talk about kind of the the way the way insurers have changed towards kind of their attitude towards mental health and mental health conditions. A lot of them now will have some sort of helpline that if you take a life insurance policy and you want to kind of speak to someone, they can provide help and support for 100%. You about that. It's a massive change. We're seeing more and more insurers kind of come across this now and realise that mental health has an absolutely massive role in people's lives.
Huge.
And without putting too harsh a point on it, the more work that insurance companies can do on that, the less on a purely financial point of view, the less likely there are people to claim on that.
Absolutely. And you're 100% correct with those value-added services, as we call them in the industry. For example, Aviva has DigiCare Plus, and a few other providers have something that's similar, and Smart Health and
fraction cover. There are all these different extras,
and they aren't just for yourself. And that's one of the main things that I would be talking about with clients when it comes to protection, that it isn't just the protection that it provides for you. It can provide that DigiPlus healthcare app that Aviva can offer you. It's for yourself and your family. So not only are you going to be protected, but say you've got a young child, they need to see a doctor. They can't be seen till Thursday because the queue's at the doctor. You can access a 24-hour GP service. It's great that insurance providers are providing this, and at the end of the day, it's only going to benefit both parties. We're offering a service that is going to benefit people when it comes to mental health, when it comes to physical health, and it's global, and it's accessible all the time. It's going to lower the chances of claims later down the line, because a lot of people, for example, don't want to go to the doctors, especially recently because of COVID. They don't feel comfortable going into a GP service, but they might feel comfortable having a half-hour slot on a phone with a trained professional at the top of their league in terms of what they do for a living, and they can get diagnosed over the phone. And it removes that anxiety for a lot of people, especially with mental health, because, like you mentioned, no one wants to talk about it. But if you can access a service on your phone and speak to a professional that is going to be a real life person, and have that session maybe 6 times a year, and it's completely free. It's off the back of your life insurance policy. That means we're less likely to pay out, because we're looking after our clients in terms of their mental and physical health as well. And it is become a lot more popular in the last, I'd say, 5 years that insurance providers are doing this. And I think it's in an attempt to, change the stigma around protection as well. It isn't just for when you die. It's for when you're alive too. And I mean, a large provider did a little bit of research into their value-added services, and I think it was a 98% satisfaction rate. 97% people said that they've recommended it to their friends. And we asked how much would they pay for it, and the customers came back and said they'd pay up to £500 for that value-added service.
They get it for free with some insurance.
Exactly. And they, when we asked to break down that cost, the customers said that £30 of that each month would be on the GP service. So that's £360 a year they're willing to pay for a virtual GP access. That shows how important it is to the clients.
And bear in mind, life insurance policies start from £6-7 quid a month.
If you're 18 and you want to take out a life insurance policy for £100,000, you can get that for £4.50. It's something I used to say before I did the role I do now. I used to sell protection directly to the public, and I'd speak to somebody in their early 20s, all the way up to maybe their late 20s, early 30s, and I'd say, why haven't you got protection yet, and what are you using it for? They might say that they need to cover, they've got a partner and they want to make sure that something's left over. Then they see the premium at the end and it's £10 a month, and they think, I don't want to do that. My first question is, have you got phone insurance? Yeah, I've got phone insurance. How much do you pay for that? About £10 a month. Okay, so what's more important, your phone or your life at the end of the day? And it switches. So it is that cheap. And when you put it into comparison, if you have a coffee a week from Costa or Starbucks or any of these big coffee shops, one coffee a week is the same amount as a life insurance policy a month. It's really not that unaffordable for a lot of people. Of course, there are people in circumstances where life insurance is just out of reach, because a lot of people have conditions that they have no control over. They've been unlucky. They have conditions that are going to make those policies more expensive. But again, there are options. For example, a lot of providers will offer you the option to take out a policy that increases in the future. So you can take a policy out and the premium will be quite low, and then sort of 80% of the policy length or term, it will start to increase again, because you've got to match the full cost of the policy. But while you are in a tough financial situation, there are policies that will start cheaper for you. And if it gets to a point where they're too expensive, everyone needs to understand that no one's tied into life insurance. You're not going to anytime. You can leave at any time. That's it. Exactly. You don't even have to. I probably shouldn't be saying this, but you don't even have to contact the life insurance provider to cancel your policy. You just got to cancel your direct debit. And I think when people start to understand that, the fear disappears about taking life insurance out, and more people do take it out. Because, for example, I had a case recently where somebody wanted to take out a life insurance policy for 3 years only. 3 years only. The advisor said to me, look, we might not even need it for 3 years because it's to cover a loan. What if he pays the loan back before the 3 years ended? Not a problem. You don't need to have the life insurance for the full term. It is really what you need, and it's there to suit you.
Those things you just want to check. And the other thing as well is to have those policies regularly checked as well. Because like you said, there are different policies that, for us, the majority of premiums that we sell with generally tend to be guaranteed premiums. We know 100%. What those premiums are every single day, month in, month out. They don't increase. But you're right, there are some times whereby, certain type of insurances might be better for people. They do start off and they do kind of go up. But, we can review those every little while anyway. So if that was to happen, having reviewed every 2, 3, 4, 5 years, absolutely fantastic.
Yeah. So, for example, clients that have a high BMI or they're currently smoking. A lot of providers nowadays, they do add a load in for ex-smokers for up to 5 years. But say you're a smoker, you want to quit, or you like I said, you've got a high BMI. You're looking to lose weight. But if you were to take out a guaranteed premium policy, the premium's going to be quite high because your BMI is quite high, and there's a load in for that. Clients can take out one of these policies that start really cheap and don't get more expensive until, say, 3, 4, 5 years down the line, lose that weight in the 2 years, or quit that smoking and have this policy for 5 years, go back to their advisor after that 2 years or after they've lost the weight, and then look at a guaranteed a policy with guaranteed premiums, because the loading's going to be removed because your BMI is in level.
Because you've changed basically. You've less of a risk, therefore your premiums are a bit less.
And most people don't understand that in life insurance. They think it is A to B, it's this much money, there's no other choice, you've either got to pay that or you don't get it, and that really isn't the case. Providers want to offer cover to absolutely everybody that they can, and that is why there are propositions like that, aren't there?
Yeah, fantastic, absolutely brilliant. So one other question that we've got kind of moving forward. First, let me just go back to the outcomes for I started on that. So basically, it's just kind of cover off. So when you go for underwriting, it's either you get accepted, declined, excluded, or potentially you might have a bit of a rating, basically.
Yeah, a rating. Yeah.
But after that, then you can kind of film that's what you want. The premium the policy goes in place. You might, for example, have a premium amount that you want to pay. So therefore, if there is a bit of a loading, sometimes what we can do is I'd rather you have some insurance than no insurance. So it means if you do have a tight budget, we can cover you kind of up to that budget, basically, and kind of have a really good shop around and change it. It's change kind of little bits and tweak it all to make sure we bring it into the kind of premium that you want to pay.
100%, and it's going back to that guaranteed premium, you get your underwriting, you get your terms applied, and your premium might be £50 a month. You can have things that we call it GIOs, or guaranteed insurability options.
Yeah, you can change those.
You can change your sum assured. Yeah, for life events. So, for example, you have a client that you sorted out their protection 5 years ago. They're coming up for a review on their mortgage. They're actually moving house. They're getting into a bigger property now. They've got kids. You can activate. Yeah, they're married. You can activate that GIO and increase the life insurance up to a certain percentage, maybe 50% of the original sum assured. And again, you can decrease it. Most providers will let you decrease your life insurance policy at any time, because to them it's a smaller payout at that point, so there's no risk to them.
And George, what insurances do you have personally?
I have life insurance and I have income protection. So the two most important things to me are if I die, I leave a legacy. There's going to be no debt for my family. I'd love to have a critical illness policy. Unfortunately, I'm a type 1 diabetic and it's quite expensive to have a critical illness policy at that point. But income protection to me at my age is really important, because if I was to get ill at any point in the next 10 years, it's going to have... I'm not in a position where I own a property. I'm not in a position where I have a passive income. So income protection is, a lot of people live paycheck to paycheck. And that is a situation that I live in at the moment. I live off my means. So income protection to me is vital. More important than life insurance to a certain extent.
There has been a recent policy, there has been a recent study that's been done as well that reckon that down south that we spend all of our money a lot more than we would maybe up north and that sort of stuff. So there's a load of research been done that reckon that, between if a client's income was to stop, normally they have around about 14 days worth of savings, I think was in this area, which is shocking. It
is shocking, and I mean, that ties into the cost of living crisis that we're all feeling at the moment. It's more than ever, following on from COVID, looking at a potential recession that we're going to be entering into. Yeah, people don't have savings, but put it this way, it's easier to spend £25 a month on an income protection policy than it is to save £25 a month. Because,
That's true, actually.
because you know, get to the end of the month and that £25 a month is that £25 there, you're going to spend it on your takeaway or a few more pints down the pub before payday.
Might have probably gone car parts.
There we go. And it's just easy to spend, but when that comes out of your bank account, the £25 is gone. But if the worst was to happen in terms of you've got to take time off work, you've got protection, and that is the most important thing. What does it mean to you? You know, what does the protection mean to you? Is it worth paying for? 9 times out of 10 it is. So Barry, what have you got in terms of protection?
Right. So we basically have mortgage decreasing term insurance, which basically covers our mortgage. So if anything happens to me and my wife, then mortgage is paid off. That means a surviving person can actually live in the property without having a mortgage on it. Both of us have income protection policies because we basically both our incomes kind of help manage the home basically. So if we didn't have one income, we'd need to kind of have both those incomes in order to pay all the bills and that sort of stuff. And then we have then a little bit of a critical illness policy, which means that it's only for a little bit. It's only for still a big bit, for about £50,000. But it means that if, say, for example, either one of us is long-term sick, it means that we can buy apparatus to kind of change the layout of the house potentially, or really we can use that chunk of money to go on like one last family holiday to make those amazing memories, to you know, really have that one last
legacy.
I've kind of to remember, for the kids to remember that great time we had, and you know, before kind of one of us. But it sounds horrible.
It sounds horrible, but
for myself, talk about death. It even kind of makes me well up and go shh.
Absolutely.
Do you know what I mean? And
death and money, two of the hardest things to talk about at all. And when it comes to life insurance, you're talking about both. And you know, just drawing off of what you just said there, critical illness, you using that for the sake of the changing the house and leaving a legacy to the kids. Income protection, you're using that to make sure that you can support the kids and your family still if they're not there, and obviously life insurance to make sure that if you were no longer here, you're supporting your kids and your partner from the grave essentially. And you know, why have you got all three of those policies? You know, why haven't? This is a question I used to get asked quite a lot. Why do I need all three of those policies?
Well, I mean, you don't. If you've been, you don't need to have. You should. You know, you don't need to have anything by law. But I recommend that you do, because for ourselves, the cost of those policies, all right, you know, our policies, we didn't take them out when we were very young. They are quite expensive. They're probably about, you know, 80 odd quid a month, which is, you know, it's not cheap. It's not kind of throw away money. But, you know, for that policy, it means that I know no matter what happens, the kids are all right.
It's that reassurance.
You know, I know no matter what happens, we're not going to leave behind an absolute thunderstorm of crap that they're going to have to kind of go through, because that's what we, as being advisor, you do kind of see that. You see the other side of it, where someone kind of sits there and goes, right, okay, so, you know, I know you did our policies, what do we do? We kind of pull up all your notes, look back. Well, actually, you know, we've got life insurance, which is kind of, you know, that's actually fun. But critical illness, it's the same. At the time you said that you didn't think you're ever going to get ill. That's a bit of a tough.
And you're going to find that, like I said, one of the hardest things to talk about is death. You'll find that people that have those three policies in place are more than happy to talk about death, because once it comes and when it comes, they know that their family are looked after. They know that everything that is going to be left behind is positive rather than negative for their family. And
one of the things we haven't covered yet, there's kind of a little bit, so like family income protection, that sort of stuff, family income benefit. Yeah, absolutely. So that again is it's not very common. A lot of people don't know about it in terms of we call it FIB, family income benefit. It's cheap. It is really cheap. Really cheap.
Yeah, really cheap. And again, it's an alternative to make sure that if anything was to happen, your family is still looked after. It's not something that I even deal with a lot, family income benefit. You know, advisors don't speak to me about it a lot. They bring it up to their clients on a regular basis, but they don't really like educating people about it because of, you know, I hate to say it, but because it is that cheap, 9 times out of 10 it is that cheap, the commission that the advisor gets isn't great, so they would rather position an income protection policy rather than a family.
They pay different things. I didn't know they paid any different. I thought they just, I mean, I honestly didn't know that. Is there a difference between those two, the different type of amounts that those policies can pay out for the premium?
In terms, so what do you mean for family income benefit?
When you said that the commission isn't the same.
So depending on the premium, the commission's obviously going to be a lot lower.
Okay.
And because family income benefit policies are 9 times out of 10 cheaper than like an income protection policy, a critical illness policy, or a life policy. Well, I say life policy, maybe not a life policy, but because it pays out while you're still alive, the advisor is 9 times out of 10 going to go to income protection for that reason. It's something that I think clients should be educated on, family income benefit.
Well, there's a need for it, really. So I mean, where we see it mostly. So say, for example, we have a family whereby you've got mum, dad not together anymore. You've got a couple of kids or whatever. The dad, for example, is paying one of the parents paying maintenance to the other parent. Even if that parent was to pass away, there's still a need for that maintenance to still be paid because you're relying, the other family members relying on that to be able to afford to be able to live every month, pay bills, kind of contribute towards the kids. So exactly. So family income protection benefit, we often see as a need for, if say, for example, there is a maintenance payment, even in the event that something did happen, means you can still cover children to the age of, I don't know, 18 or 21 or whether they come out of full-time education. Yeah, and I think,
family income benefit's great as well because say the dad wants to take the policy out on the mum's life and they're separated, they can do that. So
not if he wants to kill her off, like.
yeah, obviously not. Don't kill her off. But, if there is a main breadwinner in the family, that family then splits up, there is still protection there, and that's what family income benefit is there for. It's to make sure that the family it's in the name, at the end of the day, it's to make sure that the family is looked after if the worst was to happen. And it's not, it's obviously difficult to talk about family income benefit when, 9 times out of 10 it's used for parents that are split up. So it's, when parents split up,
you can't have that chat with them. So, by the way, when you guys do split up, how do you feel about FIB?
Exactly. And I think that's probably why it's a little bit less common. But for families that have been, for example, a couple get together and they get pregnant and they decide to split up during the pregnancy, it's a really, really good way for whatever parent wants to ensure the other parent to make sure that child's going to be supported, even though they're separated. Exactly. Yeah, it's really useful.
That's cool. So going back to, say, for example, things like life insurance, critical illness policy. So in death, a joint policy is kind of relatively simple. So a policy between two people is relatively simple because the money will generally be left to the other person as a rule of thumb. So if you have husband and wife, generally money will be left to the other person. What happens when the person, say, for example, a single person? What do you recommend they might like to do then, and why should they do it? So basically, why should a person use a trust?
So obviously, when you're single, you haven't got any natural legal beneficiaries that your estate's going to go to. You might go to your parents or a sibling, but to make sure it goes to the right person, you want to be using a trust.
Because under the rules of intestacy, which is what happens when you basically die. So say, for example, we've had clients which kind of really feel strongly about it. So for example, they might have, if everything passed away, normally it goes to your husband or wife first of all. Failing that, it then goes to your kids. After that, it then goes into your parents. After that, there's brothers and sisters, and after that, it's then, I think, is it aunties and uncles, and then
possibly
state.
It's so complicated, and it takes a long time. If you haven't got a trust and you die and the money is being divvied up between people, it can take, probate is a really long, drawn out process. The benefit of having a trust is when you pass away, you know exactly where that money is going to. You can also assign a trustee so that when you pass away, if your beneficiary at the time is, say, your child who's 3 years old, the trustee can look after that money and make sure the beneficiary is going to get it. So not only are you intending to leave that money for somebody, you know that when you pass away, it's going to be left for them. It's a legally binding contract to trust. So it has to be honoured over sort of the law of intesting. It's something that most providers will ask you to do, but we don't require it on a lot of our policies. So, for example, if you're looking at obviously business protection and things like that, that sort of life insurance requires trusts because it's offered on a life of another. But when it's personal protection, there isn't one required, but I would always recommend that you get a trust in there. You get 2 trustees and you get 2 beneficiaries as well, because even if it's a joint life policy, there are circumstances where it's a joint life policy, there's no trust in place because the idea is that the person surviving will receive the benefit. What happens if you die in a car crash with your partner? What happens if, and it's horrible to think about, it's horrible to talk about again, but what happens if your whole family's in the car and you die in a car accident and there's no trust? So even in a joint life second event policy, Put it into trust. Make sure that you know where your money's going. At the end of the day, if you had £100,000 in your bank account,
you give it to me.
Yeah, exactly. Of course, but you'd want to know where that money's going to go when you pass away, because you worked hard for that money. You're paying for your life insurance policy. You want to know where it's going.
And the other thing as well is that sort of just confirm, so even when that policy does pay out, you don't have to wait kind of weeks and months for it to go through probate to kind of get it there, and then it goes where you want it to go to nice quickly, and that's just it. It's all paid out. So that means that if any money's needed to pay for costs, to pay
funerals,
for, I know, inheritance tax, whatever else, it's all kind of there, and it's ready to
use. Of course, and as well, if you if you put money into a trust as well, and you don't necessarily need to keep the same beneficiaries in there. You can change it at any time. So, if you wanted to pick and it's horrible to think about, but you wanted to pick your
favourite child, changes.
And then it changes. Or for example,
that's not the best example.
It's not the best example, but a good example is you have your life insurance policy for 50 years.
Yeah.
Your trustees and your beneficiaries actually pass away. You can change those.
Yeah.
Or you get, later in life, you get looked after via a carer, and that carer has gone above and beyond for you, and you want to leave some money there. You can add them to the beneficiaries as well.
Not only that as well, I mean, in a sort of trust that you talk about, family conditions will change as time goes on. So for example, you might have a family just here, then for example that family dynamic changes, new partner comes in, new children. You're going to want to make sure that it's
being
kind of
divvied up,
and the way that you want it. So you probably would look saying, like a discretion trust or something like that, which is going to mean that you can actually make those changes. It's not fixed.
Absolutely, yeah. And again, for example, you might take a policy out when you've got children, because a lot of people take life insurance out because they're having children, and they might put their 3 children as beneficiaries, and all of them as trustees, or however you want it. But as those children grow up, it can be evident that one of those children is more sensible than the other 2, and you can trust them a little bit more to deal with the finances, and it really does just come down to personal preference. And as providers, providers are not going to tell you that you need to do it. They're not going to tell you how to do it. They're not going to advise you on that, because it's got nothing to do with the actual provider. But every single provider would prefer to have your policy put into trust, because 1, the claims process is so much easier, and 2, it usually means that the family are going to be happier at the end of the process as well with the provider themselves.
Okay. So again, it's probably another reason to not blow on trumpets, but kind of go see a broker, because they will actually take care.
Because trusts are a maze. If you don't know what you're looking at, you will struggle to fill that form out. And even if
it's difficult for us, we have to ring up you guys.
Yeah, and that is
trust form.
Exactly. So go to a broker for that. People go to solicitors for that, but why would you pay for it? Go to a broker. They're sorting out your life insurance. They'll put it into a trust for you, and then at the same time, if you want to make those changes, go back to your broker. They know what they're talking about.
Fantastic. Brilliant. Well, I just want to say, George, thank you very much for coming to see us, mate. It's been absolutely brilliant. We've just discussed, we've been recording for like a really long time. I didn't even realise time's just absolutely flown. So thank you very much for coming and see us.
Thank you for having me.
It's been brilliant, mate. Thank you so much indeed.
Absolute pleasure, anytime.
Well, I'm afraid that's all we've got time for today. We'd like to say is a massive thank you to our special guest. Thanks for coming and speaking to us. If you found this episode helpful. If you found this episode helpful, please don't forget to follow, subscribe, and hit that bell button to be notified of any new episodes. Thank you very much, and we'll see you again next week.